Hello, I'm Greg. The date is December 24th, 2025. Silver has just executed a move we haven't witnessed in 45 years. It smashed through the $70 per ounce barrier, reaching $70.45 and securing a staggering 140% gain for the year. You would assume this is a simple narrative about supply shortages, correct? Metal becomes rare, prices skyrocket, end of story. However, this is where the situation gets bizarre. At the precise moment silver is scaling these historic peaks, the COMEX Commodity Exchange in New York is reportedly holding 517.2 million ounces of the metal. That represents the highest inventory accumulation we have seen since late 2020. Consider that for a moment. Record-breaking prices alongside record-breaking inventory. These two realities should not coexist. Here is a pop quiz. What usually happens when you have an abundant supply of a commodity? Prices drop. Supply and demand. It is the most fundamental principle we were all taught in school. Yet, here we are, watching silver vault past its inflation-adjusted 1980 peak, while New York warehouses supposedly hold more metal than they have in half a decade. Something does not add up, and Wall Street is fully aware of it. The real question isn't simply whether silver is expensive. The question is why it is expensive when there is allegedly so much of it sitting in vaults. Let me illustrate exactly what transpired in early December. During just the first 4 trading days of the month, an unprecedented event took place at COMEX. Traders arrived demanding physical delivery of their silver contracts. They didn't want cash settlements, and they didn't want to roll their positions forward. They wanted the actual metal in their possession. They claimed 47.6 million ounces. To grasp how shocking this is, you must understand that COMEX separates its silver into 2 specific categories, eligible and registered. Eligible silver is metal stored in COMEX-approved warehouses, but it is privately owned and not available for delivery against futures contracts. Registered silver is the only thing that matters here. It is the metal that is actually available when contract holders say, "I want my silver immediately." When those demands for December delivery hit, they wiped out 60% of all registered silver in a mere 96 hours. Analysts began using a phrase we haven't heard since the Hunt brothers attempted to corner the market in 1980, vault drain emergency. This is not standard market behavior. This is panic buying wearing a suit and tie, executed through official channels with legal teams and paperwork, but it is panic buying all the same. Someone out there no longer trusts the paper market. They want the tangible asset, and they want it right now. Here is what should really capture our focus. The EFP spread, exchange for physical spreads, indicates how much traders are willing to pay to convert their paper silver contracts into physical bullion. Under normal circumstances, this spread hovers between 2 and 5 cents per ounce. It is essentially a nominal fee for the inconvenience of handling heavy metal rather than trading digital contracts. However, in December 2025, that spread blew out to between 64 and 97 cents per ounce. Let me reiterate that because it is critical. Traders are paying nearly a full dollar premium per ounce just to secure physical silver rather than paper promises. Think about the implications for your investment portfolio. If you hold silver ETFs or futures contracts, you're holding paper that claims you own silver. But the entities that actually require the metal, the ones willing to pay these massive premiums, are telling us something profound. They do not believe the paper reflects reality anymore. The financial system has constructed a beautiful illusion where 517 million ounces sit in vaults, appearing as healthy numbers on a spreadsheet, while the actual metal becomes increasingly impossible to claim. It is comparable to a bank account showing $1 million balance, but when you attempt to withdraw cash, you are informed there is a 64-cent fee per dollar just to access your own funds. This disconnect between the paper and physical markets is no longer theoretical. It is not a conspiracy theory whispered in gold bug forms. It is right there in the official data, in the EFP spreads, in the December vault drain, and in the backwardation we will analyze shortly. The COMEX system was established on a simple premise. Most traders would accept cash settlements. Only a tiny fraction would ever demand physical delivery, and the registered inventory would always be sufficient for that minority. But what happens when that premise collapses? What happens when suddenly everyone demands the real thing? You might be asking why this matters to you personally. Perhaps you don't own silver. Maybe you view this as merely an interesting market quirk. But here's the reality. Silver is not just a precious metal for investors. It is inside your smartphone right now. It is in your vehicle's electrical systems, in the solar panels being installed on roofs across America, and in the servers powering the AI systems everyone is discussing. When the financial plumbing that determines silver prices begins to crack, and when paper and physical markets start to diverge, it impacts everything from the cost of electronics to our nation's capacity to build renewable energy infrastructure. This is not just about traders making or losing fortunes. This is about the fundamental pricing mechanism for a metal that our modern economy literally cannot function without. The breakthrough to $70 wasn't a celebration. It was a warning flare fired into the night sky, visible to anyone paying attention. Record prices coupled with record inventory implies something is deeply wrong with how we measure supply. The numbers suggest abundance, yet the price action and vault drains scream scarcity. One of these signals is lying. And here's the unsettling truth. The price is likely telling us what the inventory numbers are concealing. That record 517.2 million ounces, most of it isn't actually available. It is trapped in the eligible category. Privately owned, unavailable for delivery, creating a mirage of abundance that evaporates the moment anyone attempts to claim the metal. We are witnessing a slow-motion crisis unfolding in real time. The December vault drain emergency was merely the opening act. The widening EFP spreads are telling us the crisis is accelerating, and the $70 price breakthrough is the market's way of declaring that the jig is up. The paper promises are being stress-tested, and the system is failing the test. What happens next depends on how many more traders decide they would rather hold metal than contracts. How many industrial users decide they cannot risk supply disruptions and start hoarding inventory? And how many investors realize that record COMEX holdings do not mean what they used to? The paradox of $70 silver sitting atop 517 million ounces is not a paradox at all. It is a revelation. The abundance is an illusion. The scarcity is real. And the price is finally beginning to reflect that reality. The question is not whether this trend continues. The question is how rapidly it accelerates and how high silver climbs before the paper market either adapts or breaks entirely. Now, let's discuss why this crisis was inevitable, why every warning sign was visible for years, and why the people managing our financial system either didn't see it coming or chose to ignore it. The December vault drain wasn't random bad luck. It was the logical conclusion of a mathematical problem that has been compounding since 2021. Here is the uncomfortable truth. For 5 consecutive years, from 2021 through 2025, the global silver market has consumed more silver than mines have produced, not by a small margin. We are talking about cumulative deficits totaling 820 million ounces. That is more silver than exists in all the COMEX vaults we just discussed. Think about running your household budget with expenses exceeding your income for 5 straight years. Eventually, your savings account hits zero and the credit cards are maxed out. That is exactly where we are with silver. Let me break down what 2025 alone looked like. According to the Silver Institute's December 9th report, this year is on track for a deficit between 95 and 118 million ounces. Global mine production stands at roughly 830 million ounces annually. Industrial consumption? Try 1.1 billion ounces. You do not need a degree in economics to spot the problem here. We are burning through 270 million more ounces per year than miners are extracting from the ground. For a while, this shortfall was covered by drawing down existing inventories, melting old jewelry, and recycling industrial scrap. But 5 years of deficits mean those buffers are gone. The cupboard is bare and new demand keeps accelerating. Here is where it gets truly interesting for anyone considering the next decade. 3 massive technological shifts are creating what analysts call an industrial demand tsunami, and all 3 are essentially unstoppable at this point. First up, solar energy. In 2014, solar photovoltaics consumed about 11% of industrial silver demand. Fast forward to 2024, and that number hit 29%, representing 197.6 million ounces. The European Union alone is targeting 700 gigawatts of solar capacity by 2030. Every single solar panel requires silver paste for the electrical contacts that convert sunlight into electricity. No substitute material comes close to silver's combination of conductivity, reflectivity, and durability under UV exposure. As nations race to meet climate commitments and reduce dependence on fossil fuels, every solar panel going up on a roof or in a field is claiming silver that would have been available for other uses. Then we have the electric vehicle revolution. This one should concern anyone who has been watching the transformation of the automotive industry. A traditional combustion engine vehicle uses perhaps 15 to 28 grams of silver in its electrical systems. An electric vehicle uses between 25 and 50 grams, representing a 67% to 79% increase per vehicle. Silver is found in the battery management systems, the charging infrastructure, and the power electronics that control everything from acceleration to regenerative braking. Industry projections show EVs overtaking internal combustion engines as the primary automotive silver consumer by 2027. We're not talking about a niche market anymore. We're talking about the entire global auto industry, tens of millions of vehicles per year, all demanding substantially more silver than the cars they are replacing. But here is the demand driver that should really make you sit up and pay attention: artificial intelligence and data centers. Remember when everyone was excited about AI breakthroughs in 2023 and 2024? All those ChatGPT conversations, all that image generation, and all those AI assistance companies are building into their products. Every single query runs through massive data centers packed with servers, and those servers are absolutely loaded with silver. Global IT power capacity has exploded from less than 1 gigawatt in the year 2000 to over 50 gigawatts in 2025. That is a 53-fold increase in just 25 years. Silver's electrical conductivity is unmatched by any other metal, making it irreplaceable in high-performance computing applications. As AI continues advancing and more companies deploy these technologies, the silver consumption from this sector alone could rival traditional industrial uses. You might be thinking, okay, demand is high, but can't mines just produce more? This is where geology and economics intersect in frustrating ways. Silver is rarely mined on its own. Roughly 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. When copper prices are high, mines ramp up production, and silver comes along for the ride. But you cannot simply open a pure silver mine overnight, just because prices are elevated. The permitting process takes years, construction takes years, and by the time new supply comes online, market conditions might have changed completely. Primary silver mines, the ones actually targeting silver deposits, face their own challenges with declining ore grades, meaning they are processing more rock for less metal as the easy deposits are exhausted. This brings us back to that COMEX inventory number that looks so reassuring on paper. Remember the 517.2 million ounces? Let's dissect what that actually means. COMEX uses two classifications, registered and eligible. Registered silver is metal that has been specifically designated as available for delivery against futures contracts. Eligible silver is metal sitting in COMEX-approved warehouses that meets all quality standards. But it is privately owned and cannot be claimed for contract settlement unless the owner decides to convert it to registered status. Here is the critical insight. When we talk about COMEX's ability to handle delivery demands, only registered silver matters. Eligible inventory is essentially window dressing, making the total look impressive while providing zero actual liquidity when traders show up wanting metal. In early December, when those 47.6 million ounces were claimed, they came from registered inventory. That December demand consumed 60% of available registered silver in 4 trading days. The eligible inventory, which makes up the bulk of that 517.2 million ounce headline number, sat there completely untouched because it cannot be touched. It is like advertising that your bank has billions in deposits while failing to mention that 90% of those deposits are locked in long-term CDs that cannot be withdrawn. The number looks great, but it is functionally irrelevant when customers line up at the teller window demanding cash. This registered versus eligible trap creates a dangerous psychological dynamic. Market observers, financial media, and even some professional analysts look at the total COMEX inventory and assume there's plenty of silver available. They see 517 million ounces and think the market is well supplied, that concerns about shortages are overblown, and that the system can easily handle delivery demands. But the December vault drain revealed the truth. When actual delivery pressure hits, the vast majority of that inventory effectively doesn't exist from a practical standpoint. It is silver stored at COMEX facilities, but it is not COMEX's silver to deliver. The distinction matters immensely. Most people do not understand it until a crisis forces the issue into the open. Have you noticed how your retirement account statements show your stock and bond holdings, but you probably couldn't tell me right now whether those are actual shares registered in your name or just beneficial ownership through a brokerage? That is a similar dynamic to what we are seeing with COMEX silver. The system works fine when everyone trusts the paper trail and nobody asks inconvenient questions about who actually owns what. But introduce doubt, introduce delivery pressure, introduce the possibility that paper claims might exceed physical metal, and suddenly those distinctions become the only thing that matters. The 5-year structural deficit, the industrial demand tsunami, and the registered versus eligible trap. These aren't 3 separate problems. They are 3 aspects of the same underlying crisis. Demand structurally exceeds supply. New demand sources are accelerating, not slowing. And the financial infrastructure that is supposed to provide price discovery and liquidity is built on assumptions that no longer hold true. When COMEX created the eligible category, the implicit assumption was that registered inventory would always be sufficient because most traders would cash settle their contracts. That assumption is breaking down in real time. The December vault drain proved it. The widening EFP spreads confirm it. The $70 price is the market's way of screaming it. For anyone holding physical silver right now, this analysis should be validating. You own an asset where industrial demand is exploding, where supply cannot keep pace, and where the paper market is showing stress fractures. For anyone thinking about whether to convert paper silver positions into physical metal, the EFP spread is telling you exactly what is happening. Other traders have done the math and decided paying nearly $1 premium per ounce is worth it to hold the real thing. For anyone watching from the sidelines trying to understand whether this rally has legs, the answer is written in the structural deficit numbers. This isn't speculation or momentum trading. This is fundamental supply and demand finally overwhelming a paper market that papered over reality for too long. The proof isn't circumstantial anymore. The Silver Institute's data isn't from some fringe newsletter. The COMEX inventory classifications aren't conspiracy theories. The EFP spreads aren't artifacts of market manipulation. This is all official, documented, verifiable information pointing to the same conclusion. The silver market is in the early stages of a crisis that will force a complete repricing of the metal. The only question is how high prices need to go before either new supply materializes or demand destruction occurs based on what's coming in Part 3. Neither of those outcomes happens anywhere near current prices. The math tells a very different story about where silver is headed. Let me show you something that happened in October 2025 that very few people outside professional trading circles noticed. Silver entered what is called deep backwardation. For those unfamiliar with the term, here is what it means and why it matters enormously. In normal commodity markets, contracts for future delivery trade at higher prices than immediate delivery because of storage costs, insurance, and the time value of money. You pay a premium for the convenience of not having to store and secure the metal yourself. Backwardation is when this relationship inverts, when immediate delivery costs more than future delivery. It is the market's way of saying, we need this metal right now, and we are willing to pay a premium to get it today, rather than waiting. In October, silver's backwardation reached levels we haven't seen since 1980, the year the Hunt brothers nearly broke the silver market. Front-month contracts were trading $2.88 higher than contracts for delivery 6 months out. Think about what this means. Traders were paying nearly $3 per ounce more to get silver immediately instead of waiting half a year. This isn't a small technical anomaly. This is the market screaming that physical metal is scarce right now, regardless of what the inventory numbers claim. Alongside this, silver lease rates, the interest rate charged to borrow silver for short periods, spiked to 32%. Under normal conditions, lease rates hover below 1%. When lease rates hit 32%, it means the cost of borrowing silver for even a short time period has become prohibitively expensive, signaling extreme tightness in the physical market. Here is where historical pattern recognition becomes valuable. The last time silver showed this exact combination of deep backwardation and spiking lease rates was in two specific periods: the Hunt brothers squeeze of 1980 and the rally of 2011. In 1980, silver quadrupled in price over a 9-month period as backwardation persisted and physical delivery pressure mounted. In 2011, silver rallied 71% as similar conditions played out with investors fleeing to hard assets during the European debt crisis. Both times, the backwardation persisted for 6 to 9 months before the major price explosion occurred. We entered backwardation in October 2025. If history rhymes even remotely, we are looking at a time window extending into mid-2026 for this pressure to resolve itself through substantially higher prices. But here's what makes December 2025 even more ominous than those historical precedents. December contracts traded 16 cents below the spot price. Let that sink in for a moment. Someone holding a December delivery contract could buy silver for immediate delivery at a lower price than their contract was worth. This shouldn't be possible in a functioning market. It is like buying a coupon for a restaurant meal that costs more than just paying the menu price. When this happens, it signals that the contract itself has become suspect, that traders are discounting the paper because they are not confident it represents real metal they can actually claim. The December vault drain we discussed earlier was traders acting on this exact concern, demanding physical delivery before the window closed. Let me walk you through the scenarios. If just 10% of contract holders demand physical delivery instead of cash settlement, registered silver would be completely exhausted. Not strained, not pressured, but completely gone. At 15% delivery demand, COMEX faces 3 options, none of them good. Option 1, emergency cash settlements, where the exchange essentially forces traders to accept dollars instead of metal, destroying the entire purpose of a commodity futures market and obliterating confidence in price discovery. Option 2, outright default on contracts, admitting they cannot deliver the metal they promised, triggering legal chaos and potentially unraveling the broader commodity market structure. Option 3, silver prices spike to levels where industrial users reduce consumption, where new supply sources become economically viable, and where the market rebalances at a much higher equilibrium price. That third option is what we are heading toward. The price levels required are far higher than current markets reflect. Based on the historical backwardation resolution patterns, the ongoing structural deficits, and the mathematical impossibility of meeting delivery demand with current registered inventory, here are the 3 price targets and timelines that emerge from the data. These aren't predictions pulled from thin air. They are the logical endpoints of the crisis we've been documenting. Target 1 arrives in the first quarter of 2026, and we are looking at silver reaching $80 to $85 per ounce. This represents the immediate resolution of the backwardation signal in the panic buying phase from industrial users. Think about this from their perspective. You are a solar panel manufacturer with billion-dollar contracts to fulfill, and you are watching silver supplies tighten while prices climb steadily. You know that potential tariff implementations and trade restrictions could further disrupt supply chains. What do? You start building inventory now, regardless of current prices, because the cost of production delays exceeds the cost of buying expensive silver. When multiple industries reach this conclusion simultaneously, solar manufacturers, EV producers, electronics companies, defense contractors, they create a demand surge that overwhelms available supply. $85 per ounce isn't a speculative bubble in this scenario. It is simply the price required to clear the market when industrial users are bidding against each other for limited metal. Target 2 hits in the second quarter of 2026, and this is where things get really interesting. We are projecting silver between $100 and $120 per ounce. This level is triggered if COMEX is forced to implement widespread cash settlements. Imagine you're a trader who bought silver futures contracts, specifically because you wanted the optionality to take physical delivery if conditions warranted it. You have done your analysis, seen the supply deficits, watched the vault drains, and decided to exercise your right to delivery. Then COMEX tells you, sorry, we are cash settling your contract instead. Your confidence in the paper market doesn't just decline, it evaporates completely. This is the moment when the divergence between paper and physical prices becomes undeniable and permanent. Physical silver trades at substantial premiums to paper contracts, creating a two-tier market where actual metal commands prices far above what the futures exchange claims silver is worth. $120 per ounce in this scenario isn't the top. It's the floor for physical metal as the paper market loses its price-setting authority. Target 3 extends through 2026 and 2027, and we are looking at silver between $150 and $200 per ounce. This represents the cumulative impact of everything we have discussed. The 820 million ounce deficit from 2021 through 2025, the ongoing deficits of 95 to 118 million ounces per year, the accelerating industrial demand from solar, EVs, and AI infrastructure, and the complete breakdown of the paper market's ability to suppress prices through naked short positions and leverage speculation. At these levels, silver reaches its inflation-adjusted 1980 high of $194 per ounce. That 1980 peak has been held up for decades as an unreachable speculative bubble, a cautionary tale about market manipulation. But here is what makes this time genuinely different. The 1980 spike was driven almost entirely by financial speculation and investment demand. Today's setup combines that same financial pressure with unprecedented and structurally growing industrial consumption that cannot be substituted away. You might be wondering if these price targets account for new supply coming online. The answer is yes, and the targets actually incorporate fairly optimistic assumptions about supply response. Even at $150 to $200 per ounce, the geology and economics of silver mining mean production increases will be measured and delayed. Remember that 70% of silver comes as a byproduct of other metals. High silver prices alone don't automatically translate to more production, unless copper, lead, and zinc prices also justify ramping up those operations. Primary silver mines face years-long timelines from discovery to production. The permitting process alone can take 3 to 5 years. Then construction takes another 2 to 3 years. We are talking about new supply that might hit the market in 2030 or beyond, far too late to address the deficits we are experiencing right now. What about demand destruction? Surely at $100 or $150 per ounce, some industrial users find alternatives or reduce consumption. This is where the specific nature of silver's industrial applications becomes crucial. In solar panels, silver represents roughly 3 to 5% of total panel costs. Even if silver prices triple, solar manufacturers face a 10 to 15% increase in production costs, which they can largely pass through to customers given that the economics of solar installations still work at slightly higher prices. For electric vehicles, the silver content represents an even smaller fraction of total vehicle costs. You're not going to see EV adoption stall because silver prices doubled. The performance characteristics that make silver irreplaceable in high-efficiency applications don't change just because prices rise. Demand destruction at these levels is minimal, maybe 5 to 10% from some marginal uses, but nowhere near enough to rebalance a market facing 100 million ounce annual deficits. There is a psychological element to all of this that is worth understanding, especially for anyone managing their own investment portfolio. We are conditioned to think of $70 silver as expensive because we remember when it was $15 or $20. That anchoring bias makes higher prices seem unrealistic or unsustainable. But what if $70 isn't expensive? What if $70 is simply the first step toward discovering silver's true value in a world that is electrifying transportation, deploying massive solar capacity, and building AI infrastructure that runs on silver's unmatched conductivity? The market spent decades underpricing silver because paper markets could create artificial supply through leverage, and because recycling and inventory drawdowns masked the structural deficit. Those mechanisms are exhausted. Now, we are entering a phase where price needs to do the actual work of balancing supply and demand, and the balance point is substantially higher than anyone in the mainstream financial media is currently discussing. For those of you who have been following our journey through this analysis, let's tie it all together. Part 1 showed you the paradox, record prices with record inventory, a contradiction that demanded explanation. Part 2 gave you the proof, 5 years of structural deficits, unstoppable industrial demand growth, and a registered versus eligible inventory trap that makes COMEX's headline numbers meaningless. Now, Part 3 has shown you the mathematical endgame, the backwardation signals that historically precede major price moves, the open interest numbers proving paper claims exceed physical metal by 18 to 1, and the 3 price targets with specific timelines showing where this crisis likely takes us over the next 12 to 18 months. This isn't about trying to time the market perfectly or calling an exact top. This is about recognizing that we are watching a commodity market transition from a paper-dominated pricing regime to a physical-dominated reality. The transition is messy, it is happening in real time, and it will likely accelerate through 2026 as each month's deficit adds to the cumulative shortage. The December vault drain was an early warning. The widening EFP spreads are the ongoing alarm. The backwardation is the final countdown. What comes next is the resolution.